Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Wednesday, July 17, 2024 edition. Please be sure to subscribe to this channel for the latest interpretation of financial news in the U.S. as it becomes available. Thank you for your support here. And today, ladies and gentlemen, we're going to be talking about the global economy, the risk that it has, the growth that it's looking at. We're also going to be talking about the banks, retail shopping, and new inflation warnings that are coming out here about this economy. So the good news is that this economy is still holding together pretty well, considering we're going into the second half of this year. And things are going to be slowing down here as we head into the second part of the year. The first thing we're going to talk about right now has got to do with the IMF raising the outlook for India and other countries in the BRICS. As global growth, they say, will remain lackluster. IMF, International Monetary Fund, it previously held that called India was the world's fastest growing, quote, major economy. It was expected to grow 7% in 2024. That's higher than 6.8% April's projection. China, the next second largest economy that was going to grow, was expected to grow 5% this year. That remained the same for IMF's May prediction. So growth from both India and China will account for almost half of the global growth this year. So it seems that the power is shifting eastward to the Near East, ladies and gentlemen, in terms of growth and GDP. The U.S., by contrast, is only looking at a 2% growth, GDP growth, in 2024 and 2025. And so we can see that the shift, and that makes sense because most of the production of our goods and services come from that area between India and China, and Singapore and Taiwan, stuff like that, Thailand, and they're producing a lot more. And economies who produce things, they make things, they manufacture things, those are the kind of economies that grow. Those are the kind of economies that lead the nation. They've been attracting big investors like Apple and Google, of course, as the country works towards becoming a manufacturing powerhouse. It's according to CNBC and MSNBC. So this is what India is investing in. This is what they're hoping on. And this is why the robust economic growth will continue for these countries. Now, for us, it's going to take us a while to bring manufacturing jobs back here. Whether that's AI or technology, it's going to take at least the next 10 years because, they've been shifting jobs over. And now we're importing the workforce with foreigners and other people, as you know, importing a new workforce to take over most Americans' jobs, in addition to having the AI and automation and robotics taking jobs too. So it's a double whammy for the U.S. economy, even though things look good on paper. And so these economies are going to continue to grow. We can expect the Western economies like the UK, Euro, Canada, Mexico to be kind of stagnant for the next 2-3 years. And this is going to be very concerning. This is very concerning for all of us, that we all have to prepare, because global growth is expected to grow at 3.2%. That's still unchanged. Okay, so that's not a high percentage of GDP or gross domestic product. It's growing, but not at the pace that, of course, economists would like this economy to grow at, and others. So, of course, Federal Chair Jerome Powell says that he will not wait. The central bank is not going to wait till inflation touches 2% to cut interest rates. And so they're going to go ahead and cut those rates in September probably. But he added that, quote, a hard landing for the economy is unlikely in the books. Well, we don't know that yet because we don't know how much damage was done when they printed up all these stimulus checks and printed up all these PPP loans. All that is just starting to wash out into the economy this year and next year. So we will see. But it does signal hyperinflation when you print up a massive amount of money and you don't have anything to back it up with. It's not backed by gold anymore. So we know that's the case. Now, U.S. banks, this is according to Kitco News here. I generally check them out sometimes, but U.S. banks signal economic trouble, quote, declining deposits, loan risk hit profits. Well, that also could be because we're getting ready for the CBDC or some form of digital currency that they're getting ready to do. So they're reducing the velocity of money. In other words, they're taking cash out the system, and more people are feeling it. And so they're just, more people are not taking out cash as much as they're using the credit cards and other things, because they know that, cash, the velocity of money is slowing down. And most Americans know that, we're going to be heading to some type of digital system, whether they introduce it themselves, the banks, or other people. So loan risk hit profits. So now we have a situation where we've had these high interest rates, and the banks were profiting off it because they had, people who make large deposits and fees and all of that. They were profiting off it. But now we're seeing a case now where the inflation is starting to fall, at least according to official reports. We know Shadow Stats and other people have been reporting that inflation in the U.S. is closer to 11%, 12%. But, official reports have it at 4%. So we'll go with that. That's what they have. So we'll go with that. But we know out in the street that it's a little bit different, with including food, utilities, gas, etc. The payments are higher. So But anyway, in excess, this is right here. So banks are still reporting profits. As you can see, Wells Fargo reported a 4.9 billion profit, even though they've been involved in a lot of scandals, as you know, with the car loan scandal, insurance scandal, the creating false account scandals. But they're still making profits. All these banks are still making profits, even though the article claims that that they're struggling, that they're somehow not getting record profits, but they are getting record profits as well. So the key takeaway from the earnings reports is that mounting credit card balances and risk from investments in commercial real estate continue to pose significant headwinds for the economy. So in other words, ladies and gentlemen, the debt load continues to grow for not just individual Americans, but for people who in these corporate hedge funds and corporate investments. Their debt loads are growing too, because there's a lot of empty commercial real estate in all of these mid-sized cities, large cities, and even these hinterland places. You go, every time you go, you see these signs for lease, for rent, for here, and it's all generally owned by the same big time commercial lending companies, that used to own these big time malls and all that, but they're not being filled with workers, and they're not being filled with businesses. So that's a big problem. Retail sales figures continue to show flat, but a deeper dive shows consumer resilience. So now they're painting it as we're buying, we're continuing to buy, but the thing is, we're buying essential need stuff. Like this lady here, she's buying essential things for her family: food, water, security, clothing, things of those natures. They're not going on vacations. Most people are not going on vacations more than once or twice a year. They're not buying excessive cars or with these crazy high payments. So we're buying essentials, and most Americans know that. They're not. This Marketplace article paints it as if the Americans are buying, excess amounts. So remember now, we have to keep spending, because the economy of the U.S., 75% is based on our spending. Everyday American spending. That's what keeps the money going around. That's what keeps the economy going around. If you don't get paid, I don't get paid. A business doesn't get paid. The money cycle goes around and around, and the business cycle goes around and around, from up and down. So we have to keep spending, because that's the nature of this capitalistic type economy that we're in right now. That's going to be changing, as you know. So look. They're saying now that this lady was in Brooklyn, blah, blah, blah. She says she bought a Target bottle of soy milk, $4.99, but at the local fresh market is $6.50, and she wanted to support local businesses. Now, I agree with that. If you can, with certain products, most of the time people shop at different stores. Some people shop at the same grocery store, and get everything there, but some people like to bounce around and get different products from different stores because they just have a higher quality, or maybe they just like the brand better, so it's okay to do both. But definitely try to support your local businesses, because there's so many few businesses out there, that they, the local business is being killed by the monopolies now. And this is just like 1929, ladies and gentlemen. We had monopolies. We had mergers, monopolies and mergers. Look out for that information in the next couple of months, whether it's in the airline sector, the transportation sector, the hospitality, the food sector. Look out for mergers and acquisitions. That's going to be the key, because that's what happened in 1929, the build-up. We had a lot of mergers. People were buying out stock for crazy amounts of prices, and this is exactly what we're going to see today, but at a faster pace. Now, new inflation warning. This is CNN Business, okay? Get used to high interest rates, okay? That's what the IMF says. IMF is the International Monetary Fund, as you can see here. They're saying high interest rate. Well, no kidding, Sherlock. We're going to have high interest rates around the world for the next 10 years, just like we had zero interest rates that messed up the economy and caused everybody to have all this free, cheap money. We're going to have high interest rates, high prices for services, which includes haircuts, hotels, and restaurants, as well as escalating trade tensions, right, are propping up inflation and raising the prospect that interest rates will stay high for a while yet. So even if they cut rates, it's not going to matter. It's going to be a slow cut down to their target 2%. And at this point, the damage has been done, because it's about the amount of money that's printed up in the system, and it's about the purchasing power of Americans. So, like Alan Greenspan said years ago, he said that we can guarantee that the dollar will still be stable, but we can't guarantee the amount of purchasing power it has, and that's the key part. So yeah, they can cut interest rates, but your dollar still is going to buy less in the U.S. It's going to buy more abroad in certain developing countries, but it's going to buy less in the U.S. and prices are going to be just absolutely absurd. Same with the Bank of England, same with European Central Bank, German Bank, Asian Bank, Australian Bank, you name it, Indian Bank, because they all tend to follow each other, and we know that. So tariffs will hurt living standards. This is also key too as well. These tariffs are going to hurt living standards in both the U.S. and the European economy. And big cities are going to be the first to feel it in these suburbs, and then it's going to spill out into other cities in America and in the UK and in Europe, Eurozone as well. And so this is going to be very, very concerning as we head into the summer and the fall months. What are they going to do to keep prices stable? Because they haven't been keeping prices stable, even though they may be cutting interest rates in September. And it's not a guarantee they would do that. If inflation jumps back up, remember we still have August numbers to come in and July numbers. So if inflation doesn't improve, if the numbers come in higher than expected, then guess what? They're going to postpone that rate cut, buddy, until December or possibly after the election, or possibly not get one at all. You may just keep rates unchanged. That's a possibility. So we're not out of the woods yet. But the good news is the economy is still ticking along right now, and everybody seems to be stable. But like I said, one black swan event can change all of that, ladies and gentlemen. And that's why we always preach being prepared. Try to be prepared the best you can. You can't be prepared for every situation, but you can be prepared, with your family as best you can in terms of in your community, as far as learning how to grow your own food, getting a little bit independent of the system. It's hard to get totally off the grid, obviously, but at least learn how to grow your own food, start car sharing, different things you can do to help save money as we go through this kind of slowdown that we'll be expecting. So anyway, I'll talk to you very soon as we get more numbers coming in on Thursday with the jobs report tomorrow. We'll see what happens at 8:30 Eastern time. God bless. Talk to you soon. Take care and be safe out there. Thank you.